Hello friends, welcome back to this YouTube channel. David here. Have you ever wondered which company should I invest in? Do you just tikam, or you just follow the price movement of the company share price? Oh, it's going up, let's buy. FOMO. Then when the company share price is going down, then you're, oh no, it's going down, it's crashing, sell. Or do you follow some YouTube thumbnail that says this company will 10x, this will 100x? One of the methods in investing is called value investing. It's basically the art of buying a stock that is being traded at a discount to its fundamental value. Say for example, you have a farm, and based on the income that this farm generates, by right this business should be worth 100,000. But it's currently listed for 70,000. So essentially you're buying this farm at a discount because you have a 30,000 upside based on the fundamentals and profitability of this farm. This method alone should not be used on its own, which I will share towards the end of this video why, but it's one of the major methods that people use to assess the fundamental value of the company. No matter what, even for people who claim that they don't do any value investing, they still need to find some matrix to understand and assess the fundamental value of a company. So with this video, my intention is to help you to learn how to fish. I will share with you a main method to assess the company's fundamental value and also several financial terms so that you'll be able to better understand and appreciate an analyst's thinking or their approach when they discuss about their assumptions to assess a company's fundamental value. But before I proceed, there's one investment that you can make without losing any money, and that's to smash the like button. It will help with the YouTube algorithm, and do subscribe if you like what you have seen so far. In return, I will show you a cute puppy video as a gesture of appreciation. Now, some disclaimer here. The intention with value investing is to never predict the stock price in the short term, but rather to determine with a high level of confidence the stock price in the long run. And by long run, I mean 3 to 5 years. Why? Because it's all about the fundamentals. In the short term, the stock price may not reflect the fundamental value of the business, but in the long run, the fundamental value of the business will always reflect on its own. Just like in the words of Benjamin Graham, in the short run, the market is like a voting machine based on which company is popular, which company is not popular. But in the long run, it's a weighing machine because the fundamental value of the business will always reflect itself. Just to give you an example, say for example Apple. Based on the iPhones and based on the services it sells, this company cannot be selling for 1 million, right? It has to worth much more than that because the fundamental value of the business is significantly higher. Therefore, what I'm trying to say is that your probability of winning is definitely much higher in the long run with long-term investing rather than trying to predict the short-term price. So in today's video, I'm going to share with you about the discounted cash flow method. So basically the concept with discounted cash flow is that you determine how much a company is worth based on all the future cash flow that the company generates. Say for example, you assume that this company will continue to generate profit for the next 30 years, and this 30 years combined worth of cash flow is the valuation of the business. For example, say you have a coffee store business and every year your profit is 10,000. So you assume that this business will continue for the next 30 years, and therefore 30 years times 10,000, this means that the valuation of the business is 300,000 because 10,000 times 30 years. So essentially you are assuming that the valuation of this business is worth 30 years of its income. Now, of course, this is an oversimplified version and there's more to it. So without further ado, let's dive into it. To build a DCF, first you need a revenue, which is the sales of the company, and projects its revenue for the next 5 to 10 years, which is called the years of projection. Say you sell 10,000 cups of coffee and each cup of coffee sells for $10. Therefore, the yearly sales is 10,000 cups times $10, which is 100,000. This is called your revenue. And then say you assume a 10% growth throughout the years of projection. Done. So now we have the revenue throughout the years of projection from year 2021 to year 2030. But for each cup of coffee you sell, there's a cost. You need to buy the coffee beans, you need to hire staff. This is also known as the cost of goods, cost of operation. Say the yearly cost is $70,000, and therefore with 100,000 minus 70,000, you are left with 30,000. This 30,000 is your earnings, which is also known as Ebitda, earnings before interest, tax, depreciation and amortization. Therefore, your Ebitda or slash margin is only 30%. which is 30,000. 30,000 out of 100,000 is 30%. So for the purpose of this exercise, we're just going to assume that the Ebitda is 30% throughout the years of projection. So what you do next is you take this 30% of Ebitda and you deduct tax, interest, and you apply other financial treatments to derive the free cash flow. Now, this free cash flow is the balance of the cash that is left after deducting all the tax, the interest, and so forth. Now, why do you need to find out the free cash flow? Because by finding out the free cash flow, you will determine the valuation of the business. I will illustrate how. First, you take the Ebitda and you remove D&A. In this case here is 10,000 to derive the EBIT. EBIT is something similar as your operating income. Basically, EBIT is Ebitda but taking out the DA portion, the depreciation and amortization portion. So with this EBIT, you apply tax. Now, what is D&A? Why do you need to remove D&A before applying tax? D&A stands for depreciation and amortization. Depreciation is like you buy a coffee machine or other capital assets. They have a value, but their value depreciate over time. Amortization is something similar but in non-tangible form. For example, like your intellectual property, for example, your patent. Why do you need to remove D&A before applying tax? Because D&A are liabilities. They lose value over time and hence it's not fair to tax them. Now, with the EBIT, you apply tax so that you tax the right amount. After tax, you're left with this amount, and you take this after tax amount, add back the D&A earlier, and minus off the capital expense to derive the free cash flow. Now, this is the free cash flow throughout your years of projection. And with this free cash flow, combined together, it will form the company's valuation. However, it does not stop here. Because the value of money depreciates over time, you need to account for that. For example, for $100 in year 2021, it can buy you a fancy meal in a restaurant. But the same $100 can only get you a sandwich in year 2040. $100 in year 2030 is worth a lot less in year 2021. Hence, you need to bring it back to today's value. This is called the discount rate. You can call it as an inflation rate, but there's more to that. The discount rate is determined using a method called WACC, Weighted Average Cost of Capital. Now imagine your company has a stack of cash, but it loses value over time due to the loan interest payment, due to your obligation to pay a certain percentage back to the investors as a ROI. Let's say this stack of cash is $100, but by next year, it will only be left with $90. Why? Because 3% goes to the loan interest payment and 7% goes to paying back the investors. So in this case here, the discount rate is about 10%. There's a cost to your capital. This cost is the WACC. It is a weighted average on the cost of interest and equity. You can go to Investopedia to learn more about the formula, but in short, the WACC determines your discount rate. Typically, the discount rate for different industry varies. For tech industry, it's usually about 8 to 10%. So after you apply discount rate to your free cash flow and therefore bringing back the future cash flow to today's present value, you combine this present value of free cash flow and that is your valuation of the business. However, you still need to factor in the future cash flow component beyond your years of projection. Why? Because your business will still run after year 2030. How do you incorporate the future profit into the business valuation? There are essentially two methods. The first method is what we call a perpetual growth method. In this method, you assume that the business will run on forever and ever. So first, you assume a conservative growth rate that the company will grow on forever and ever. Say in this case here, 5%. Then you take this free cash flow on year 2030 and you apply this 5% growth. This will determine the free cash flow on year 2031. Then you apply this formula to derive the terminal value. Terminal value here means that from year 2031 onwards to forever, this is how much free cash flow that will be generated. Meaning to say, this is the cash flow from year 2031 to eternity. However, again, you need to apply a discount rate to this terminal value to bring it back to today's value. Meaning this sum will be worth this amount in year 2021. So finally, you can determine the value of this company by combining the present value of year 2021 to year 2030 free cash flow combined with the present value of terminal value to form the intrinsic value of this company. meaning this company's value should be worth this amount. And to determine the share price, simply divide this intrinsic value by the number of outstanding shares. So the share price here is $232.69. This means that even if you buy the share of this company at 232.69, you are purchasing it at a fair value and you can expect a 10% annual return. Because remember, there's a 10% discount rate that was being applied earlier. However, if you buy it at $200, meaning to say you are buying it cheaper with a 14% upside. Now for the second method is much simpler. You just take the Ebitda of the company and apply it by a multiple. For example, say 25. So essentially you're assuming that the company is worth 25 years of its Ebitda. And after you multiply, this is the terminal value. Again, you apply the discount rate to the terminal value to bring it back to the present value. You less debt plus cash and you derive at the value of the company, which is the market cap. And to determine the share price, you just divide the number of outstanding shares. The multiples of each industry varies. For tech industry, it's usually about 25. Sometimes you heard of a term called PE ratio, also known as the price to earnings ratio. PE ratio is basically EBIT multiplied by a multiple factor. It's similar to the second method except that it uses EBIT instead of Ebitda. So this is how you calculate the share price of a company. Most people will just use the second method, which is the Ebitda multiple method. Value investing and calculating how much a company is worth is important, but do not fall into the trap of value bargain. Because a company may be cheap, but it may not be growing the right direction, it may not be innovative or lack a growth driver. Sometimes a company is cheap because people do not want it, but of course this is not necessarily always the case. So for high growth tech companies, most of the time is cash flow negative, and even if there is profit, whatever profit that's remaining is used to reinvest back to the company to drive growth. So do not be surprised if you see a ridiculously high PE ratio, because the EBIT or Ebitda here may be tiny. For example, say like Amazon. The P ratio back in 2013 is 3,000 at one point, and then it subsequently dropped to negative and then go back to 1,000. It fluctuates a lot. So back then, if you do not invest in Amazon because of the high P ratio, then essentially you're missing out a 15x investment return. For every $1 you invest into Amazon, you will have gotten back $15. So my point here is do not let DCF alone determine your investment decision. In my opinion, for high growth companies, it's more important to invest in a company that solves problems that were not solved before, rather than investing in a company that is profitable. Why? Because a company can always be profitable by cutting some costs to make it look profitable, but it may lack a long-term growth strategy. It may not have a strategic direction. The purpose of DCF here is to help you determine the long-term price target of the company that you're considering to invest in. If your DCF shows that Tesla is going to be 3,000 in 10 years' time, then currently at this price of 900, you don't have to worry because you still have a 3x return of investment. So you may ask, David, but where do I find all these financial figures like Ebitda or EBIT or revenue? Well, you can just go to Seeking Alpha or Yahoo Finance to find out these numbers. They actually have a financial statement there. So wrapping up, this is the basis on how I evaluate the company, whether is it undervalued or overvalued. And it helps me to form a price target of the company so that I know by what stage I should exit and by what stage I can enter. It will also be a basis of my future coverage of the stock that we're going to discuss about. And I'm still learning on this because if you found out anything that is misaligned, please feel free to let me know. I hope you learned something today. And as always, invest safe, take care, I love you guys. One of the methods in investing is called value investing. It's the what? One of the methods of value investing, it's the art of buying